What's going on, y'all? Brandon from Vegas. Welcome back to Won't You Be My Neighbor. As always, we are here with the legend himself, my co-host, Mr. Bill Gaylord. What's going on, Bill?
Brandon, I'm happy to be here once again.
Today, we are going to be discussing conventional loans, how to qualify for them, what they're for, and most importantly, how they compare to FHA loans now that FHA did that dramatic MIP reduction.
Yeah, it's made a huge difference.
Sure. So how do conventional loans compete? What is the market saying about conventional versus FHA, what we're seeing? But before we dive into that, Bill, I always want to hit you with something Vegas related. What do you think of all of the hype around the Sphere right now?
You know, that thing is the most incredible thing there is. It lights up. I'm so pumped up about Las Vegas.
Yeah.
Everything that comes here. And that thing here now, I mean, it is a tourist attraction. I can't wait to go to a concert in there.
Well, that's going to be incredible,
Unbelievable.
Right? I'm not sure if they're going to have the band on the thing or sound waves on the thing or what they're going to be playing, right? But like, imagine if the people on the outside are seeing the concert or seeing like the instruments the same way you are on the inside, right? It'll attract people not just inside the spectacle, but like
yeah, it's unbelievable. The definition that it has is unreal.
It's just a shame that the first band there is going to be U2, and I really don't feel like hearing A Beautiful Day. I'm going to pay $1,000 to hear the Joshua Tree for the 50th time. Like, come on.
We need like Lil Uzi there for like the first.
Oh my God! Yeah, the opening.
I mean, there's
opening
some
act.
good U2 songs. You know, there's some good stuff.
Lil Uzi, we reincarnate. Eazy-E, get NWA back.
I want them to do like a wrestling show in the Sphere. I
Like
want them.
I would love The Rock.
Yeah, like
I want
The Rock.
man.
Yeah,
But they're
I'd
fighting
to
like they're
come back
climbing
from
up
The
the
Rock.
up the Sphere. Yeah, 100%. I know you're not big on a lot of the TikTok scrolling, but for the whole past 2 weeks, TikTok has been the Sphere is a meme where they take the Sphere and then you input like your own video onto the Sphere. So it'll be like when my boyfriend says he's doing his bachelor party in Vegas, and it's just the girl's face on the Sphere, like looking around for him, like what's he doing? And it's just,
I got to go on and look at this.
it's huge.
You get the good ones. Mine are all inappropriate.
Well, that's because you choose those.
But I don't
No,
think
it's just my For You page is just like, check this out. And I'm like,
Because they know
all right, I'll
they know
watch.
what you like, mother trucker. They know what you like. Your For You page is your psychic.
I want to, one day I want to show you guys just how chaotic my For You page is. Because there's like, it's not like, oh, he likes animals or makeup, or it's just like, okay, here's this guy jumping off a trampoline into some Legos. Here's this dude getting into a street fight. Here's this guy
Jumping
doing
into Legos.
if you
that
were-
cannot be fun.
No.
For him, it is.
Oh
He's making
my
money.
God.
If you were single, I tell people, man, you can figure out everything you need to know about somebody just scrolling through their TikTok For You page. TikTok knows you better than your own mother. It's unbelievable.
My gosh.
But yeah, so the Sphere has been crazy, and it continues this trend of what we're talking about, where more and more people are moving to Vegas,
totally.
which means more and more rental properties, more and more houses, and more real estate education is needed. So today is the second part of our loan discussion. We did FHA loan part 1 and part 2. If you guys missed that, go back and check those out. We talked about the new premiums for FHA loans and how it's going to save you money. And now we need to talk about the other side, which is conventional, because truthfully, would you say 90% or higher of our loans that we do are conventional FHA?
Yes, that's a true fact.
Yeah.
Almost all loans out there are conventional and FHA.
FHA, honestly.
But FHA has really made a comeback, and that's because of the lowering of the FHA MIP premium, the mortgage insurance premium.
Yeah, because I feel like, again, there's no data, right? Because nobody's going to give us this answer. But it felt like the government felt like it was losing control of the real estate market, right? Because now everybody was going conventional. The FHA was too expensive. So they made a change so that now they are, once again, the primary lenders.
It's huge. I mean, we look at it every single day now. And you're right. Conventional used to be like, well, let's put them in a conventional loan.
Yeah.
Now it's like, oh wow, we got to really compare the two.
Sure, because now the FHA in Vegas is up to $500,000.
Yep.
And you get that lower insurance premium, the lower down payment, the lower credit, and that's where I want to start right now. Why wouldn't someone go conventional? Well, the obvious answer is it's harder to qualify for, right? So what are the qualifications needed in terms of financing and credit for conventional loans?
So conventional mortgages, basically the threshold for credit score is 620. But 620 is not going to get you there. And even at 660, it's not that great. 680, you might start thinking about it. But if you have a low down payment on a conventional mortgage, what ends up happening is your rate is going to be higher on conventional. It's higher than a FHA loan, number one. And then number two, if you have a low credit score on conventional, you're gonna pay a higher mortgage insurance rate as well.
Sure. So there's more penalties on the conventional loan for having subpar credit,
Correct.
or for having subpar financing.
Yep.
Right. Whereas we don't see the same penalties with the FHA.
No.
You say about 620 is the minimum, 680 is where you prefer. What I typically tell people with conventional loans is 640 plus. The reason for that is on the realtor side, that's where you qualify for down payment assistance, right? Right. Like that is most people who are coming in trying to save money. That's their goal. So I tell them 640, but you believe 680 is more appropriate to get the rates you want.
Yeah, I mean, I'm looking at it now, Brandon. If you're putting down less than 10% on a home, and you have a credit score below 700, FHA is now probably better than the conventional. Conventional is more for high credit score borrowers. And when I say high credit score, I'm talking 740 and above. And that's where you're going to get better interest rates. You're going to get a lower mortgage insurance premium. And then it starts to make more sense to go conventional.
100%.
And 20% down, always conventional.
Yeah, 100%. If you've got 20%, there's a lot of people who still think you have to put 20% down on conventional. Can you clear that up for them? We're going to do a whole segment on why 20%. In fact, I think I'm going to finish today with my little rant on why 20% is a lie. But can you explain to people how much they can put down on a conventional loan?
Yeah, so conventional loan, there's actually a program for 3% down, which is less down than an FHA loan.
But that's for first-time buyers.
That's for first-time buyers. There's some qualifications there. There's some income restrictions as well. But that's as low. Normal conventional mortgage, 5% down, 10% down, 15, 20. But 5% is typically what we see on a conventional mortgage.
Sure. As we discussed last time, you could do anything from 3 to 99%, right?
Yes.
Like the advantage of the conventional loan is that you get to dictate the terms based on your financial position.
Correct.
So if you want to put 50% down, you can. If you want to put 3% down and you qualify for a first-time buyer, you can. And I think that's ultimately the pull of the conventional is that you get to control and dictate the numbers. Hey, I want my mortgage to be $1,900. Okay. On a conventional loan, you can do that. You'll have to put a significant amount
of money down, yeah.
But if that's what you want your mortgage to be, the conventional loan allows you that freedom in lending.
Right. And the conventional loan, again, it's really more right now for higher quality borrowers.
Yes.
High FICO borrowers.
Yes.
Because then you can get a little bit lower interest rate and your mortgage insurance premium can go lower than FHA.
Yeah. So right now on average, right? So I use the word average. Let's just say the typical buyer comes to you, credit score, anywhere between 640 and 680, they got 3 to 5% down. Right now, does it make sense for that person to go conventional? Or are you always going to say, hey, FHA is going to save you more money?
Before, Brandon, so FHA made that change in May and they flipped from 0.85% mortgage insurance premium and brought it down to 0.55%. So what does that mean? It's essentially more than 0.25% lower than it was before. And so now the FHA is such a good program that if they're in the 600s, I look at the conventional, but like probably 95% now, I'm going FHA.
Yeah.
And part of it too is that some people, credit is a game, right? We talk about it. Credit's a game. It's trying to understand how to get your credit score better. And so they may be at 680. We put them in an FHA loan. You're going to get a little bit lower interest rate. You're going to get a lower mortgage insurance premium. But as rates drop, we're going to help them improve their credit score during that time period so that they can qualify for a conventional loan and potentially remove all mortgage insurance through a refinance because rates are elevated.
That's another advantage of a conventional loan is that when it comes time to refinance or when it comes time to maybe adjust your rate, with FHA, we need to first convert you to a conventional loan, which comes with a cost, right? Whereas with a conventional loan, I have a conventional loan. I put down 5%. A couple of years later, I got enough equity to hit 20%. I don't have to come to you and refinance, right? I can just say, hey, Bill, between the down payment and my current equity, I'm at 20%, right?
Correct.
And what would that trigger for you? Would you then call an appraiser? Is that your next step?
The next step is whoever they're making their mortgage payment to, they would call them. That's called the servicer. And so they would call the servicer and say, hey, I think I've got enough equity in my home. I'd like to see if I can remove my mortgage insurance. That person on the other line would say, okay, here's the steps, what we need to do. And the step typically is get an appraisal done. And they'll order the appraisal. They'll have the appraisal come in. If it comes in where they show that they have 20% equity position, then they remove mortgage insurance automatically, and they just keep making their payment without the mortgage insurance.
Oh, so sometimes it can trigger automatically on the mortgage side.
Well, if it will trigger automatically after your payment is amortized down, meaning you pay your loan down to a 78% loan to value from when you first purchased it.
Okay.
I wouldn't recommend that because that's going to take a while. It could take 11 years or thereabouts.
Sure.
So if you know that properties have appreciated and you know that your property's gone up in value, sometimes you could remove it within a 2-year period. It just, I mean, what we saw previously over the last few years, I mean, you saw skyrocketing
If you bought a
appreciation.
house from 2018 to 2020 in Vegas,
You remove it.
right now you probably have enough equity to either refinance or get your 20%. Honestly,
Yeah.
honestly, there are very specific locations that didn't get that equity burst. But if you're anywhere, Summerlin, Lone Mountain, Southwest Vegas, anywhere by Durango Station, anywhere at Green Valley or Henderson, you've probably made the equity in the past 3 to 4 years to accomplish this, right?
Yeah, and so it's really just it's the cost of the appraisal to remove it, and that's pretty much all you have to
And
do.
they keep raising that damn appraisal. Appraisers, if you're watching this, can we have an appraiser come on the show and explain to us why appraisals went from $300 to $10 million overnight? Like what? Can y'all explain
can you explain?
God. I get it. Like when groceries get more expensive, right? I get it. Like distribution's more expensive. Maybe sales is more expensive. When appraisers get more expensive, I'm like, what are the costs that have gone up for you?
Yeah, well, the problem with that, I mean, we're going sidetracked, but problem with that is they put in essentially a middleman to control it. And so
the
middleman
fees
now is taking money, and so the appraisers want to make the same money.
Sure.
So they're basically paying both.
Appraisers like, hey, gas has gone up.
Yeah.
I got to drive out to your crib. I need $600. There's no way around it.
No,
We just had a new build. I know we're sidetracked, but it's a fun story. We just had a new build close, right? And the new builder called my clients for the appraisal. My clients are like, how much is it? $700. Can we skip the appraisal? I don't even care how much the house is worth. I'd rather have the $700.
Well, I want to tell you also about conventional,
Yeah.
kind of circling back with conventional. We just had a client, had a great financial profile, good credit, had money in the bank, putting 20% down, and we got what's called a property inspection waiver, meaning there was no appraisal done. So it's called a PIW. And so because of their financial profile, we didn't have to get an appraisal.
That's right. That's right. In fact, I wanted to ask you about that.
Yeah,
situation.
and that's on conventional. That doesn't happen on FHA.
On FHA, there's no escaping the inspection or the appraisal, right? Because
Correct.
it's a government loan. They have government standards, right? What does it take to get that waiver? How well what are the numbers to qualify for that inspection waiver?
So typically what we've seen is they have to put 20% down.
Okay.
Somewhere in that ballpark.
Okay.
The one that we just had, they were 20% down. FICO scores were about 780, and they had leftover reserves in their bank account after closing of about $80,000.
So they had enough.
It's the full financial profile. Can they figure this out? And it doesn't always have to be money in the bank. It could be just really good credit. It could be that the property, when the automated underwriting system goes through, finds a property, and they see that maybe the value is very good. So they're like, we're comfortable with the value.
The value was very good, by the way. No, I like that.
It was. You are the master negotiator. This guy, I just don't see that. Whatever you've been doing,
We're on a hot streak.
I don't know, man.
Don't-
It's awesome.
I don't want to jinx it by patting myself on the back too hard, right?
Here, I'll do it for you.
No, it makes sense when you explain it like that because a lot of people don't understand with the recent housing crash, a lot of the system is designed to protect buyers from themselves. I get calls from buyers like, well, can I qualify for the house with no income or no job? And I'm like, why are you trying to take on $3,000 of debt with no job? Like, protect yourself. And a lot of these rules are designed to protect the buyer from their own. You know how many buyers would waive appraisal if they didn't have me telling them not to do it?
Yeah.
You know how many buyers who are just like, well, waive the appraisal, let's get the house. No! That's how you end up with a house $40,000 under. Like, they need protection from themselves. And that's
Correct.
why I like that the inspection waiver, you have to have 20% down. And then on top of the 20%, you have to have enough money reserved that the 20% still leaves you comfortable.
Right.
I like that. It sounds draconian, but man, a lot of times you have to protect buyers from their own bad habits.
Yeah, for sure. And I look at, you talk about, calling up and I have no income and I have no money and I have no, we talk about the three-legged stool, right? You have to have three legs in order for the stool to stand.
like that.
Right?
Yeah.
And I call it credit, income, and assets. Assets being a fancy word for money. And so you have to have all three in order to qualify for a loan. Sometimes you're shoring up money for the down payment. Sometimes you have to, wait another year to count commission income. Sometimes you have to shore up your credit. But you have to have those three legs in order for that stool to
qualify.
stand. Yep.
100%. I think this is good. I think, I honestly think there's going to be a part 2 to this because I do feel like we left some things on the table where I think we should sit down and just do a whole episode on conventional versus FHA.
Yeah,
line
I'd
by
love that.
line, credit needed for each, deposit needed for each, pros and cons of each so people can see their own side, right? The way I try to describe conventional loans, since I'm, foodie guy, conventional loans are like a nicer dinner, right? I can go to a nicer restaurant
T-Bones.
and still get
That's my
T-Bones.
favorite, man.
I like T-Bones.
I love that place.
You can go to T-Bones, and if I want to order the cheap stuff on T-Bones, I have that option. I don't have to do T-Bones expensively.
No.
But if I have the money and I want the service catered to me, I can go to T-Bones and get a great expensive steak. I have the option of cheap meal or expensive meal.
Right.
And I'm also going to get better service at T-Bones because I'm spending more money.
Right.
Better service than I would get at a McDonald's or a Chipotle. And that's how I compare FHA loans to conventional loans. FHA loans may be cheaper up front, but you're not going to get the 5-star service that you could possibly achieve with a conventional loan.
Yeah. And I'm going to just finish up here by saying I like the FHA loan as kind of a stepping stone to the conventional loan. And you can get into an FHA loan, lower priced mortgage payment, and then as time goes on, you improve your credit and you move up into the conventional
What
loan.
Bill is saying is don't take a girl to Carbone until she's willing to go to the Olive Garden. You feel me? All right? It's a stepping stone. You go to Olive Garden, then Carbone.
Then Carbone.
All right?
Yes.
Olive Garden, then Carbone.
Yeah.
Do we have any questions in the chat?
Yeah, we have one from God's Ark Testimony. It says, after the refinance, can I buy another property with FHA?
Yes.
Oh, yeah. Matter of fact, that's a whole episode, but the answer is yes. The way to abuse the FHA loan by refinancing it and then you technically don't have an FHA loan anymore, it's fantastic.
Well, you can have an FHA loan and then buy another property with an FHA loan. We're doing that right now.
Like while currently in the first FHA loan or after refinancing that into a conventional?
No, FHA. So they're keeping the FHA loan because they have the low interest rate, and if you do the blended rate, it's lower than going out and refinancing. So they're keeping that FHA loan and they're buying a new property with a new FHA loan. They've just their plans changed, family grew, they're just going into a different loan.
So how many FHAs can you have at one time? Obviously, like debt to income matters with each loan, but I didn't know if there was a limit on how many FHAs you can have at one time.
That's a good question, Austin, but I don't think there is a limit. Basically, when you buy with FHA, it's your intent to occupy the property as your primary residence. And as long as it's your primary residence, it's an FHA loan.
So what if you have 3 of them? Are they all your primary residence?
No, you can't do that.
Okay, so there is a limit.
Well, I mean, No, as long as you qualify, but look at it this way. Let's say you have an FHA loan that the property's worth $700,000 now, and then they're buying another property that's worth $400,000. The underwriter's going to go, this is not going to be your primary residence. Why are you going from a 700 to a 400,000? But if you bought your initial FHA property, and let's say now that property is worth $400,000, and now you want to buy a $500,000 property because your family's grown, the underwriter is going to go, oh, well, this makes sense. It's, they're moving up. They need more space. They're buying a better property. So you just has to make sense.
You got to rent the other one out.
Gotcha. So there's another question. Not a lot of context. Says, what about the 100 miles from the other FHA property? I don't know if maybe that makes sense to you guys, but
the 100-mile club. No, basically they're saying like a second home, or it has to be a certain distance from there. And I don't know if they're thinking about buying it as a second home or a primary residence. It just, as long as they're looking at the property as their primary residence and that's where they're going to live, it doesn't matter. The FHA could be less than 100 miles as long as it's primary residence.
Good questions, though.
Yeah.
Good questions.
I
Yeah.
love it.
yeah, I think that's it for questions at least.
Perfect.
For
Well,
now.
Bill, always thank you for you guys' time. I'm doing fist pounds today, man. My hands are a little delicate from the gym this morning. I got the calluses.
We got to get you into class with me, Brandon. You'll toughen up real fast.
No, I'm fine. Exactly the toughness level.
But here's
that
the
I
thing,
am
though.
right now.
It doesn't hurt. It's not like boxing or kickboxing where you're getting punched.
Oh,
You're just rolling.
I'm not worried about the hurt. I just don't want to slap fives with my calloused hands. One of them might burst. I got delicate fingers,
God.
Hey, guys, thank you guys for
delicate
tuning
guy.
in. Come on, man. All of us got to be something. Thank you guys for tuning in for our lesson on conventional loans. We'll be doing another one next week as a follow-up, comparing conventional versus FHA line by line. As always, come and be my neighbor. Have a good one, Bill.